Okay, so we have several things to go over today, and I want to thank everyone for joining us. Well, Tina, do you have any client scenarios that you'd like to throw past before we dive into a few deal stories of the week?
I want to get every one of my clients. Well, I have a small clientele, but they own a lot of different businesses, like I was just off the phone with Ryan, and he started 4 more. So, they own several different businesses. So I want to get every single one of these guys in front of you because the first thing I want to do is, they need to have like a management company so that they can have some of the additional tax strategies available to them. These are all young entrepreneurs that are married with small children. None of them have any life insurance. So we need life insurance for them and the wife. And then I want to put together some different retirement plan packages that I can kind of like, if it's just them and the wife, then we put them into this package, put them into that package. And then also I'm interested because, we did this mineral and oil and gas with this one big sale to circumvent that. I have another client or 2 other people that did some big sales that they didn't tell me about ahead of time that I'd like to talk to about that. But one question that I have is that I have like some doctors that I just do tax returns for. They make about $500,000 in their W-2. And, they have like $1 million houses, but that's all they've got. So they have a Schedule A because they have so much interest expense. But, can someone participate in the mineral or the oil and gas, like on a monthly basis, like a small amount to because I have them withholding an awful lot of tax, single plus 0 plus extra to keep them from having to pay estimated taxes. And they have no vehicles. They may end up getting vehicles to run business in, but is it possible to do the mineral or the oil and the gas on let's say they do $5,000 a month, and then over the course of the year they get X dollars, and then that would have they'd be able to take that?
So with some of these individuals, Tina, in certain scenarios, what you're asking for, yes, is available. In other scenarios, no, it is not. But what it comes down to is stepping in as a strategic advisor to provide almost like family CFO services. I mean, that sounds fancy, doesn't it? Stepping in and helping them manage their household as if it were a business. And I say their household because they're W-2 employees, and with their primary income coming from some other employer, they only have so much they can do. And you've already identified some of those strategies. They can do the minerals, but we have a minimum of 50 grand, right? They can do oil and gas, and then there's various oil and gas opportunities out there. Most often, though, the really good ones that I often recommend to my clients also have a minimum of 50 grand. And so how is it that we help them accomplish exactly what you're saying, monthly being able to put away 5 to 10,000 and just be gaining that benefit over time? With a lot of our clients, and I learned this from an associate of mine, Aaron Bennett with Bennett Financials. He provides CFO services to a lot of small business owners, but sometimes also takes on clients who are not business owners, but are high W-2 individuals, and helps them manage their household as if it were a business. And he has a methodology called profit first. Profit first. So essentially, just as you're talking about, as money comes in, then we're putting money away. And we're moving money from column A to column B to get a deduction, deferral, or an exemption. In this scenario, a charitable deduction, a non-cash charitable deduction with a mineral strategy. Or we're getting an oil and gas, which, this was established back in 1918, that individuals who would help promote the exploration and benefit from the intangible drilling expenses from a general partnership that is uncovering or initiating the process to drill for oil and gas, right? And there's this incentive that almost up to, not always exactly, but almost up to every penny on the dollar that people put into that, they're able to get an offset or deduction, or at least 92 cents or 98 cents. It just depends on the company that you're going with and how much they allocate to that versus depreciation or whatever else, right?
Right.
And then they make it back with working interest, which is wonderful. that they not only put their money there, they got an immediate deduction, but they get their money back over so many years. So what we oftentimes do is we set up an investment account so that they're able to invest in certain assets, typically dividend producing stocks right now in today's current environment. They're putting away the 5 to 10 grand every single month. They're still doing that as their W-2 income comes in, because they're not business owners. They're making their money, but they're allocating. So instead of, normal people, they see how much money they have in their checking account and they go spend it and some, right?
That's my problem.
So we're helping them operate their family like a business, like a mini family office, even though there's not multiple businesses or possibly not multiple revenue sources, but their paycheck that comes in, net of taxes, everything else, they can be putting away certain amounts as if it were withholding for taxes, but now it's withholding for the mineral strategy. It's withholding for the oil and gas strategy. And they can be doing that $2,000, $5,000, $10,000 every single month into a Charles Schwab account or another bank account. It's just whatever they're comfortable with, right? Oftentimes we try to help them win in the margins. So meaning, getting them a very conservative 4, 6, 8, 12%, depending on the risk tolerance, right? During whatever the movements the market's doing, there's always a suitable investment makeup for every single client based on their future goal or desire, which is short term, right? So you got to be very careful with how we invest those funds, because they are wanting by the fall. So here we are, June, July, August almost, and they may want to make a contribution in 4 to 6 months. They might want to deploy those funds, or depending on their tax scenario, they might be putting this money away for these strategies, and they might put away more than they deem to, so that they have some that they can put now, maybe November, December, and then some again in January, February, so that they can stagger some of their benefit. And so there's several charitable strategies, whether it's donor advised funds, the mineral strategy, the oil and gas strategy. There are some people, based on their desires and everything else that they're hoping to accomplish, that we help them set up mini foundations as well as full-scale foundations. And all of that can play into their short-term and their long-term tax strategies. But from the question of, trying to get them to save on their own 50 grand so that they can participate in oil and gas, or 50 grand so they can do the minerals strategy, can be difficult unless you, almost as if it were part of their paycheck withholding, you set it up so that every month, part of their paycheck goes into a different account, or every month as it goes into their main account, it then leaves a day or two after into this separate account that they are essentially saving or putting money aside, so that come November, December, they can make these other strategic moves.
Well, like the one I just did, she's a gastroenterologist. And so I had extra taken out, so she's actually going to get a $6,600 refund, which she's all excited about. I mean, you'd think she won the lottery. But she literally just spends like nobody's, and she's, divorced, 2 children, but she can't, she only files 1. But literally spends all her money. Now she does have retirement with the hospital and all that type of stuff, but I've increased her withholding so much that her total tax line was something like $175,000, so that I could cover it so she wouldn't have to make it. So what I would do is just say, okay, we're going to take your tax withholding down, but then that other money that you would have had withheld up from your pay stub, we're going to have it ACH'd out of I have to have it ACH'd out of their, maybe what I'd have to do is split their direct deposit of their paycheck into the checking account, and another one that's like another savings account, ACH out there, because I literally have got to keep the money out of their hands so that they don't have the opportunity to make a decision.
Mm-hmm. Now, you're doing this to help them because people can't help themselves oftentimes, right? But
yeah, especially when you're 45 years or 41 years old and gorgeous and making $500,000.
Right. They can't help themselves. But
no.
Exactly like what you're doing, you're helping them operate as if they're a mini family office. And you're going so far deep into this to the point where their employer, all of their employers can deposit into multiple accounts. And right. You can help them analyze what withholdings they currently have. And if they're making $500,000, they're withholding a whole bunch. You can.
Well, plus I'm having extra. I added extra. So what I'm going to do is show them that I'm going to just move the money from this spot to this spot. So they're not spending any more money. That's what the thought process I'm going to try and get through.
Yes. At the end of the day, you can tell them how we're going to move money from column A to column B. And the difference is, instead of column B being the government for taxes and withholdings, we're going to make the column B you, just in a different way. And we're going to get a deduction, deferral, or an exemption because of moving it there. So instead of paying so much in taxes, we're able to fund some of these other strategies and overall pay less in taxes and help them increase their net worth.
We'll help them save some of this money. I mean, they do have, they do participate, in the 401k that the hospital has. But I mean, to make this much money, be so young, I mean, they should be wealthy. I mean, they have $1 million house, but they also have $1 million mortgage.
Mm-hmm. Yeah. So high cash flow individuals, and how can they optimize their cash flow? And not just look at their cash flow, but look at their tax flow. And optimizing cash flow means increasing it. Optimizing tax flow means decreasing it. Those are usually two-edged swords that don't usually work together unless we implement these other strategies like the oil and gas, the mineral, some of these, donor advised funds and things of that nature.
Yeah, when I emailed her about her tax return, I said, although you're because I needed direct deposit information for the $6,600 that she thought was lottery money. And I was like, I said, but, your total tax line, your total tax that you're donating to the government was, $145,000. And I would like to look at some ways that instead of you donating that money every year to the government, you use that in a way to reduce your tax liability. We just move it from that column A to column B so that you can, have tax savings and then retire, put some additional retirement away and maybe invest in a business. She's got small kids that are going to want to go to college, which she's going to be able to afford to do. But, maybe set up some trust for these kids. I mean, she's making a whole bunch of money. She's got, middle schoolers, do something.
Shane, I was going to point out there's another individual here that has a similar client. I don't know if Shane, if you can hear us now, if you can chime in for a second. Maybe he's taking a phone call just real quick. But he asked me to step in on one of his clients in a very similar situation. And they were very interested in, so they were maxing out 401k. They had their other investment accounts. So they had a lot of stock market exposure. And so one of the additional things that we were able to bring to them, Tina, was some of these non-marketable security investment options. So these are general partnerships. These are syndications. These are direct placement programs. And we were able to point them in a direction to where they can get some. So invest in a utility company, invest in a company that sells electrical components. And then they were able to kind of balance everything instead of having their entire financial world locked up in marketable securities that are long-term, because a lot of them are retirement accounts or non-qualified accounts, but long-term because things are down at the moment, right? So they don't want to pull out at this very moment. They were able to get some alternative investments. And then in addition to that, one of the items that is very key amongst a lot of these physician and physician groups are cash value life insurance policies that are structured correctly, not the way that a lot of insurance agents structure them, but in such a way that they have the best overall outcome based on their funding goals, and being able to have this diversification of tax status amongst their assets in the future. What do I mean by that? So they have certain things that are taxable to them now, which is like their W-2 paycheck. They have certain things that have tax preferential status currently, such as those items subject to capital gains. A lot of the items in their non-qualified accounts, such as stocks that they've purchased that have grown over time, when they sell them, they're only partially taxable at capital gains rate, not ordinary income rate, right? And then some of them have real estate that they're buying and selling, some rental properties, the rents, which are ordinary income, the sale of those rental properties, which would be capital gains. And then beyond that, oftentimes one of the best areas to have the most tax favored asset is under the shell of a life insurance policy. Now, these life insurance policies for a lot of these physicians, we're either doing it through their employer as a restricted property trust, or we're doing a premium finance policy with them individually. The difference there is the restricted property trust, if their employer, if if they're like ER docs and they have a separate entity from the hospital or what have you, might be willing to offer a special benefit to some of the physicians that is deductible against their income now. But if their employer is not willing to participate, then we have the other cash value policies that we can work with. And if their overall net worth is high enough, 5 million and above, we can consider a premium financed life insurance policy where essentially you're using other people's money to fund this policy over time, which eventually internally pays off its own debt. And the individual is left with a very large death benefit and a very large cash value that they can pull income from to retire off of on a tax-free basis. And so those are some other strategies that oftentimes we bring in, and it ends up solving several different issues at once for a lot of these high W-2 income earners.
So that's just one client. And then I have the other ones that own all the businesses. They either could have, SEPs or 401ks or, whatever that we could do to, have life insurance as a benefit.
So one of the things that we ought to do is there are some individuals that join these calls. There's David Bush, there's Shane Kelly, there's the two Newton brothers, and there's a few others, another fellow named Melvin. We ought to align some of these individuals that can put together, kind of like we did at Seven Figure Firms. We put together a tax plan, but a little bit more robust on the financial aspect of it, showing the benefits of moving items from column A to column B and make it very illustrative for a number of your clients. And
right.
Working together with this type of joint partnership where there's a few advisors coming together here to make it possible on a volume type scalable level for a lot of your clients, where simply we're taking in a different client and we're rinsing what we did for the last client, but repeating some of the same strategies with the new data, the new scenario. It's something that can be very helpful for a lot of your clients, and that, a lot of your clients who are physicians, a lot of your clients who, like you mentioned, are opening up tons of businesses like all of the time. They probably are not yet to the level of having a family office, but they could benefit very likely from a mini family office structure to keep all of the entities under control.
Well, Ryan's he got a $2 million line of credit at a bank, plus he got a bunch of idle money from all the different companies. And right now he's got real estate holdings. He just emailed me 3 more properties that are going to be, that's probably going to be about $800,000 because he's buying them in cash, and then the bank is giving him 70% back into a thing. So he's got that $2 million. So he's using that. Plus then for the residentials, he's doing 30-year mortgages. So I think that he's gone from just, the last time you talked to him, from having, a couple $100,000 a year of income to several million in the last 6 months.
And those people, as they scale, as you mentioned, from a couple $100,000 of net profit to income in the ranges of millions, they need additional strategies, and they need to level up, so to speak, with the things that they're doing internally. He would probably be an excellent client for having a glorified rainy day fund that is deductible to his businesses, that he's able to set aside money if in case there's an insurable risk or a claim that could occur for his businesses that is otherwise not covered by his normal property and casualty insurance policies.
Because he's buying both residential and commercial. And then he bought his wife a building that's commercial because his wife decided that she needed something to do. And of course, it wasn't the dental hygienist that he sent her to school for because their baby just turned 1 year old. And then, he also has a high schooler. So she's opening up a venue type of thing. So he bought her a building for that, which he's also going to have a couple other renters for. And then she's opening up this venue business.
Definitely a lot of moving parts and a lot of things going on.
And no life insurance on these people still.
There's a lot of debt going around, and there's a lot of assets that need protecting as well. So definitely a client where we should do a risk mitigation review to uncover all the areas that, based on certain scenarios, they could be at risk. and then help them decide what the priorities are as far as how to properly cover and not only, how do I say this, balance their portfolio of assets, but also have a good understanding of where their risks lie for each asset. That's an interesting thing that a lot of people don't take into consideration. And maybe I need to explain it in some different words, but a lot of times people are in such an accumulation phase because business is going well. They're using their cash cow business to buy up all these other things like the rental properties, everything else. And they're not acknowledging how their portfolio of assets is changing. And then they're not flipping that portfolio of assets on the side to see the risks associated with every one of those assets.
Well, I mean, they're young 40s. They think they're going to live forever. So, you know, my neighbor across the street, his daughter, about the same age, they weren't married, but they've been together for 14 years. And they have a business together and a child. And he was just involved in a plane crash March 13th and died.
My goodness.
No life insurance because, you know, they don't think about it because they're going to live forever. So, but I need to package this within this, you know, like for Ryan's one business that's making, you know, the telemarketing management company that has like about a $300,000 profit, regardless of what strategies I try and that's after I've pulled out all the strategies I can into it. We need like a benefit package that includes the life insurance and, you know, whatever we can put in there that we can get deductible. I mean, he even asked me if there's a way to get the nanny because they hired, you know, now they've got the child and child care, I guess. But, you know, I mean, you know, some companies, they provide child care for their employees. And I was wondering if there's a way we could bundle that into it. So, I mean, and then I've got the other one that was the partnership, but now they're not the partnership. So, I mean, I just have like this list of 25 people that I've got to put them in these, I've got to get them, and as long as we can deduct it and I can show them that they're saving taxes, but they're getting protection for their family, they're getting this paid, they're getting that paid and all that. I just have got to put some kind of package together, but I don't know where to go to get that package except for you. And then, to be honest with you, I've gotten a little greedy, and maybe it's about time, is that, you know, I would like to kind of put myself, I did get my real estate license, so I can get a 1% referral fee on any real estate transaction. So I would like to get myself in a position where I've got some residual income because I am getting older and I would like to have some, you know, I don't know if I need to maybe get my life insurance license in Florida or I don't know.
Well, let's go over some of these items offline so that we can review and prioritize those 25 clients and all of their scenarios and situations. I might assist you with part of the planning and might hand part of the planning off to certain people on my team so that they can help fill in the gaps for a lot of those individuals. I think there's ample opportunity, and right now being July is a perfect time to be doing planning for the rest of the year.
Right.
And step by step, understanding how to properly build the clients for these plans, and then the implementation of those plans, how that can occur and be accomplished before year end. There's also one of the items that I'd like to go over just quickly right now that I think some of your business owner clients would benefit from greatly would be that of a micro captive or a reinsurance company. And we've talked about that in the past, and I've presented it here before, but just very high level. Essentially, the government has allowed that businesses, now almost any business owner is subject to some form of risk. Otherwise, they wouldn't be for profit, so to speak, if that makes sense. If everything was guaranteed and there was no risk, then it wouldn't really be a business. But essentially, businesses are allowed to self-insure. And we've all heard people say that. A lot of times they're talking about self-insuring for a health insurance plan or self-insuring for something very specific. But in general terms, there's a number of enterprise risks that are eligible to almost any business that has clients, any business that markets itself, any business that has a product or service that they deliver, and any business that has revenue or income. Now, there are some cost-benefit analysis work that needs to be done. A lot of times people, whenever they heard the word captive, and if they were familiar with it, they always thought, well, that's something that the Fortune 500 companies do, and we're too small for that. In a lot of scenarios historically, let's say 10, 15 years back, that could have been the case by and large, because providers of an 831B strategy or a reinsurance or micro captive oftentimes gouge clients with fees. Now, oftentimes have so many fees that are not very transparent that the clients, even after doing it for a year, don't know what they're paying in fees. I've had the educational opportunity of reviewing several different companies across several different providers of this strategy from across the company. And some of them to this day, I can't tell you what they charge, because I had to essentially go through the ledgers of a client's books, not from the provider that was billing them, but I had to go through the company's ledgers to see all the stuff that was taken out. And it was over 120 grand. It's just like 12, 13, 14, 15 different ways. We have narrowed down our providers to 2 different groups that we highly recommend, because one, their fees are incredibly affordable for those individuals who are making $1 million and above. And oftentimes, as a very conservative recommendation, we only recommend our clients putting away 10 to 15% of gross revenues in an effort to self-insure for the first couple of years. And then after that, sometimes we get even more conservative so that they can start creating this pool of funds should they have a catastrophic event or some other type of insurance claim, while at the same time, they're able to benefit from the arbitrage of this strategy. So in year 1, they put away, let's say a client's making $1 million and they put away 10%, that's 100 grand. They put away 100 grand into a newly formed company. And that 100 grand, to help offset some of the fees and expenses, oftentimes we invest it in a company investment account, like a corporate asset management account. And let's say that company doesn't have an insurable claim for a number of years. That money that they put away, which otherwise would have been taxed at ordinary income rates, after it's been held for a year and a day and it meets certain rules, it actually is recharacterized and becomes assets of the company. No longer is it ordinary income, but should the owner of that side company decide to take those funds out, they come out as a qualified dividend rather than income from operations. Now, qualified dividends, we know that they have a different tax rate than ordinary income. So simply by holding it in the strategy for 1 year, they have an arbitrage. If they're in the state of Florida and the highest tax bracket, which is just federal, is 37%, and they hold it for a year and a day, and they take it out at the highest tax bracket for a qualified dividend, that's 20%. They have a 17% tax savings just from moving money from column A, ordinary income, to column B and qualifying as a qualified dividend. Now, most clients actually don't have a lot of insurance claims from this insurance company that they set up to insure their operations. They oftentimes participate in other people's claims within the pool more often than their own. And that sounds almost scary. I'm going to use my money that I'm putting aside to participate in somebody else's insurance claim. Well, the importance of having a very large pool to participate in fact, I had a client who put away, I think he put away $2.2 million a couple of years ago, and he had to participate in somebody else's insurance claim to the tune of $600. He put away 2.2, and somebody else had a catastrophic claim where everybody in the pool had to help them out. And his percentage, where he was putting in one of the larger amounts, so his percentage was one of the larger dollar amounts, was only $600. And that helped check off one of the boxes for the IRS that qualifies this as a deductible strategy. Anyway, most people, however, end up utilizing this cash-centric business, this insurance company. Now we're going to understand a little bit more about why Warren Buffett sold a couple banks that he used to own and bought insurance companies. And without going too deep into it, the owners of the insurance company can borrow from the assets internally, the liquid assets. And so essentially they can replace some of the cash or marketable securities. They can liquidate them and replace it with a promissory note. They can take shareholder loans from funds that are not held in reserve for insurance claims, so not current year policy premiums, but premiums for policies that have expired, that have moved over into surplus. They can borrow against those assets so that they can go buy that other piece of real estate, or so that they can do things personally or in other business ventures. And so the most popular use of this strategy a few years down the road is that there's sufficient assets there that they now have a rainy day fund that they can borrow from for building other assets. And it becomes a financial tool, an incredible financial tool that a lot of these Fortune 500 companies have been using for decades, that now your common business owner that makes over $1 million is also eligible to participate in. Now, if they are in a state that also has state income taxes, sometimes we've had clients that only made $500,000 that implement this strategy, knowing and understanding the costs of it all, but it still makes sense to them from a tax flow standpoint because of the state income taxes as well that they're saving on by doing this. So that is one of the items that I wanted to go over today, because I felt like this past week we've had so many people asking about that. Plus, this is a strategy that, if abused, can call attention to you. And that is perhaps the last piece that I want to touch on before we end today's call. We very proactively, for all of our clients, assist in filling out the form 886. So 8886. And that's just an informational form. There's no signature places on this form. But anybody that participates in a micro-captive strategy, thanks to some physician groups, by the way, on the West Coast back in 2015, who abused this strategy, we proactively fill this form out with our clients and help make sure that it's sent in a timely manner so that the IRS, they don't have to go through their electronic systems of checks to have red flags show up that, oh my goodness, one year this client spent $2,000 on insurance and the next year he spent $200,000. What's going on? We are proactively telling them that, hey, by the way, Mr. and Mrs. Client have this business. This business is taking a large insurance deduction. We are filling out a form 8886, and we are explaining that they're starting to self-insure, that they have this micro-captive. And by the way, we are including this form on both their business return and the personal return so that you are notified and that you are aware. And to date, over the last couple of years of doing this, we have had zero, knock on wood, zero of our clients contacted by the IRS for participating in a strategy that shows up on the Dirty Dozen list. And how does that happen? It's because we are implementing best practices. We check off all the boxes that the IRS has for, a solid deduction of this otherwise Dirty Dozen listed strategy. But we do it in such a way that even the IRS agent who disallowed this strategy a couple of years ago in 2017 from the 2015 case, he's now since gone into private practice. He does consulting, and he himself is the one showing us how to check all the boxes for the IRS and ensure that this strategy does not get disallowed, that we do it correctly. And by the way, should the IRS pull one of our clients out of the hat of 2,000 people that they always pull somebody's name out and want to review, we also, through our providers, provide this lifetime audit protection on these strategies. So not only have we not had to make good on that promise, we provide that as an extra level of insurance to our clients that they can, through a best practices approach, implement these time-tested strategies. As long as they listen to our advice and don't abuse these strategies, they are able to take these deductions and benefit from this amazing financial tool that we call a micro-captive or reinsurance company. Now, today, I do have some clients coming in to visit in person, and we do have to end just a little bit early, but look forward to a very structured schedule in the near future. We have some business owners out in California who are looking for a tailored presentation for some of their small family office needs. And we will be providing that to the public here either on Tuesdays that we've been doing this presentation, or we might move it to Wednesday. And so it will be presented with materials. Instead of just seeing my face during the presentation, you'll actually see other guest speakers, as well as a lot of the actual IRS code with materials and handouts and an outline to help cater to the needs of these individuals that have made very specific requests. So look forward to that. And of course, after this call, if we weren't able to answer all of your questions, send an email over and we'll try to get with you within the next 24 to 48 hours, at least with a response to your email, and try to schedule some time to go over your clients' current and future situations. Any comments on today's session before we do close? I have one more minute before I have to take off. I got a thumbs up from Mark. Mark, was today's session a good session?
Good job. Appreciate it. Always learn something.
Yes, and a lot of fun things as well. And look forward, not just, as I mentioned, the presentation, but we'll be providing materials of the things that I discussed on future sessions as well. All right, Tina, any last words?
You're just a wealth of information. So if you're opening your mouth, I want to be listening.
Very good. Well, I appreciate you. All right, everybody. Have a fantastic Tuesday. Good luck this week with all of your clients. And again, reach out should you have any questions, and we'll do our best to respond quickly. All right. Thank you now.
Thank you.
Bye-bye.